Ever wondered why some profitable companies suddenly go bankrupt? The answer often lies in cash flow. Welcome to the world of finance, where sometimes profit doesn't equate to survival. It's a puzzling landscape filled with unexpected pitfalls and unanticipated rewards. And at the heart of this financial labyrinth, there's a crucial concept that often leaves even the most seasoned entrepreneurs scratching their heads: cash flow. Cash flow, in its simplest form, is the movement of money into and out of your business. Imagine your business as a tank of water. The money coming in, your revenue, is like the water flowing into the tank. The money going out, your expenses, is like the water flowing out. The objective is to always have water in the tank. If the tank runs dry, your business is in hot water, metaphorically speaking. Now, you might be thinking, but if a company is making profits, shouldn't it always have cash? Well, that's where things get tricky. Profit and cash flow are not the same. Profit is an accounting concept that takes into account revenues and expenses, irrespective of whether the money has actually been received or paid out. Cash flow, on the other hand, is all about the actual movement of money. Let's take an example. Suppose you run a business that sells widgets. You sell 100 widgets in a month on credit, and after deducting all your costs, you're left with a healthy profit. But here's the catch. You haven't received the cash yet. Your customers will pay you in 60 days. In the meantime, you have salaries to pay, rent to cover, and suppliers who won't wait. If you don't have enough cash reserves to cover these costs, you could find yourself in a financial pickle, even though your books show a profit. So, it's not just about making profits, it's about managing your cash flow effectively. Mismanagement of cash flow can lead to business failure. It's like a silent killer that creeps up on businesses, even the seemingly profitable ones. So, what is cash flow and how can you manage it effectively? Stay tuned to find out. In its simplest terms, cash flow is the movement of money in and out of your business. But let's dive a bit deeper, shall we? Imagine cash flow as the lifeblood of your business. It's the money that's coming in from your customers or clients who are buying your products or services, and it's also the money that's going out to pay your expenses. This constant ebb and flow of money can be classified into three types: operational, investing, and financing cash flow. Operational cash flow is the money generated from your day-to-day business operations. It's the cash you receive from selling your products or services minus the cash you pay to produce and sell those products or services. For instance, a bakery's operational cash flow would be the money it makes from selling bread and pastries, minus the cost of ingredients, rent, and wages. Investing cash flow, on the other hand, refers to the money that's spent or earned from investments in your business. This could be the purchase or sale of physical assets or investments in other businesses. For our bakery example, investing cash flow could be the purchase of a new oven or the sale of an old delivery van. Lastly, we have financing cash flow. This represents the money that's moving between the business and its owners, investors, or creditors. It includes things like loans, dividends, and equity investments. So, if our bakery owner decided to take out a loan to expand their business, or if they decided to pay dividends to their shareholders, those transactions would fall under financing cash flow. These three types of cash flow provide a comprehensive picture of your business's financial health. They show where your money is coming from, where it's going, and how it's being used. In essence, understanding cash flow isn't just about monitoring the movement of money, it's about understanding the heart of your business. Now that you know what cash flow is, you might be wondering how you can improve it. We'll explore that next. Improving cash flow isn't about making more sales, it's about managing your money better. Now let's dive into some strategies that can help you do just that. One of the most straightforward ways to increase cash flow is by reducing expenses. This could be as simple as eliminating unnecessary costs or negotiating better deals with suppliers. Remember, every penny saved is a penny earned. And in the world of business, those pennies can quickly add up to a significant boost in your cash flow. Next, let's consider your accounts receivable turnover. This is a measure of how quickly your customers pay their bills. The faster they pay, the better your cash flow will be. So how can you improve this turnover? Well, you might offer early payment discounts or enforce stricter payment terms. These strategies can incentivize your customers to pay more quickly, thereby increasing your cash flow. Now, on to inventory management. Keeping a large amount of inventory on hand might seem like a good idea, but it can actually tie up a lot of your cash. Instead, try to keep your inventory levels as lean as possible. This means only ordering what you need, when you need it. Adopting a just-in-time inventory system can be a great way to achieve this. By doing so, You're freeing up cash that can be used elsewhere in your business. But it's not just about managing what's coming in and going out, it's also about timing. You want to time your inflows and outflows so that you always have enough cash on hand. This might involve negotiating longer payment terms with suppliers or scheduling regular payments from customers. And finally, it's about understanding your business cycle. Some businesses are seasonal, which means their cash flow can fluctuate throughout the year. By understanding these patterns, you can better plan for the highs and lows. But even with the best strategies, you can still run into cash flow problems. That's where forecasting comes in. So stay tuned as we delve into the power of forecasting in our next segment. Cash flow forecasting is your financial crystal ball. It can help you anticipate problems before they become crises. So, how do you create this magical tool? Let's dive in. Firstly, you need to understand that a cash flow forecast is essentially a projection of your business's cash inflow and outflow over a certain period of time. It's like a roadmap, guiding you through the financial landscape of your business. The key factors to consider are your historical data, your current financial situation, and your future plans. Start by examining your past cash flow. This will give you a solid foundation to build upon. Look for patterns and trends. Are there times of the year when your cash flow dips? Are there periods when it spikes? These insights will be invaluable in creating your forecast. Next, take stock of your current financial situation. How much cash do you have on hand? What are your regular expenses? What are your expected revenues? Be realistic. Overestimating your future cash inflow or underestimating your outflow can lead to trouble down the line. Then consider your future plans. Are you planning to expand your business? Are you expecting a big contract? These events will impact your cash flow and should be factored into your forecast. Once you have your cash flow forecast, it's not a case of set it and forget it. This is a living document that needs to be regularly updated and adjusted. Economic conditions change, unexpected expenses pop up, new opportunities arise. Your forecast should reflect these changes. Regularly reviewing and updating your forecast will allow you to anticipate potential cash flow issues. It will give you the time to take corrective action before a minor issue becomes a major crisis. Remember, a cash flow forecast is not a guarantee of future success. It's a tool to help you manage your business's finances more effectively. It's a way to anticipate and prepare for the financial challenges and opportunities that lie ahead. With a good forecast, you're well equipped to manage your cash flow. But don't forget the importance of regular review and adjustment. So let's recap what we've learned about cash flow. Cash flow in its most basic form is the movement of money in and out of your business. It's like the heartbeat of your operations, keeping everything running smoothly. And like a heartbeat, it's essential to keep an eye on it to ensure it's healthy and strong. We've talked about the three types of cash flow: operational, investing, and financing. Operational cash flow is the core of your business, the money generated from your day-to-day operations. Investing cash flow comes from your investments in assets like equipment or property, and financing cash flow is derived from your financial activities, such as loans or equity. Each of these plays a crucial role in your business, and understanding them can help you make more informed decisions. But understanding isn't enough. You also need strategies to improve your cash flow. We've discussed several strategies, such as negotiating better payment terms with suppliers, managing inventory efficiently, and focusing on customer retention. However, even with the best strategies, cash flow can be unpredictable. That's where forecasting comes in. By predicting your future cash flow, you can prepare for potential pitfalls and take advantage of opportunities. It's like having a map for a journey. It won't prevent all problems, but it can help you navigate through them more effectively. Finally, we've stressed the importance of regular cash flow review. It's not a one-and-done task, but a continuous process. Regular review allows you to spot trends, identify issues, and adjust your strategies accordingly. It's the key to maintaining healthy cash flow, and ultimately, a thriving business. Remember, cash flow is the lifeblood of your business. Manage it well, and your business will thrive. Ignore it, and you might find yourself in trouble, no matter how profitable you are. So keep your eyes on that cash flow, and here's to your business success.